When we talk about investing in the stock market, one of the biggest pros of investing in stocks is that there's a low barrier to entry. You can start investing in stocks now with as little as $100, even as little as $5, because there are a ton of online brokerages. So if you have a few extra bucks, you can start investing, and you can start investing in the companies that make whatever favorite products you have. If you like Amazon, you can buy the Amazon company. If you like Chipotle, you can buy a piece of the Chipotle company. And if you like the Apple AirPods, well, you can buy a piece of the Apple company. For as little as a few dollars, you can become one of the owners of the companies that you're spending money at. And now you're becoming an asset owner. Instead of just spending all of your money, you are owning the business that's creating those products. See, it's a mindset shift, and the great thing about this is you don't need a ton of money to start. Pro number 2 is you get to choose your income strategy. If you remember when I was talking about real estate, the name of the game in real estate was cash flow. I love cash flow. Other people will not. And so now when we talk about stocks, you can choose the game. You can choose to invest for cash flow, or you can choose to invest for growth. And they're two completely different investment strategies. Because when you're investing for growth, this means you're looking for companies that are not trying to make huge profits. Because if a company's making a huge profit, that means that they're not reinvesting all of their money. And if you're thinking about growth, you want a company to take all of that profit and dump it back into the company. Turn that cash into fuel on your fire to grow this company bigger, stronger, faster, and more market share, because that's how you're going to see the biggest growth in the stock price. And when you follow that strategy, you also don't have to worry about taxes, because if a company is not making profits, they don't have to pay taxes. So they get to use all of their money and then maybe use debt and other sources of capital to grow faster. And you don't have to worry about you paying taxes or the company paying taxes because you don't have any income. Versus if you're investing for income in the stock market, this means generally you're investing in a dividend-paying stock or a dividend-paying fund. What does that mean? This means that a company, say McDonald's, has billions of dollars of extra cash in their bank account at the end of the year. And then they might save a little bit, they might reinvest some back into the company, and then they say, we're already really big. We don't want to keep reinvesting more and more dollars, so we're just going to give this money away. We're going to give this money away to our shareholders, people like you who own one of the shares of the company. And then they give you a check. They actually just deposit it into your brokerage account, but this is a dividend. So every 3 months, meaning every quarter, you get money deposited into your account, which is great. This is cash flow. But here's the problem. When you get that cash, you got to worry about taxes. So you get to choose your destiny here in the stock market. You can choose to invest for cash flow. You can choose to invest for growth. Versus with real estate, the name of the game is generally cash flow. The third pro when it comes to the stock market is it is much more passive ownership on you. When you go and you invest in the Amazon company, you don't have to go into the Amazon factory. You don't have to go into the Amazon headquarters, and you don't have to tell all of your friends to start shopping on Amazon. That's what the CEO, that's what the employees are working at. You are just an owner of the company. You don't have to worry about the management or the day-to-day stuff, because they have the employees that are working day-to-day. When you invest in the company, you're just a passive owner. You can't tell the company what to do, although you can partake in the voting rights, because when you invest in a company, you get voting rights as well. But you don't get to tell the CEO what to do at Amazon or Chipotle or Apple. Versus when you own the rental property, you are the operator. It's up to you to fire the manager if they don't do a good job. It's up to you to fire a contractor if they're not doing a good job. All that now falls onto you, and you are the decision maker. But it's not all sunshine and rainbows with the stock market either, because you got some cons. Con number 1 is that investing in the stock market can be an emotional roller coaster, especially if you are a newer investor. When you go and you buy a property, let's say you buy a house, and you buy the house at 8 in the morning. At 12:30 after lunch, are you going to go onto Zillow to see what the new house value is for your property? Probably not, because you know that this is a long-term investment that you just made, so whatever price swings happen in 4 hours probably don't make any difference. But when it comes to the stock market, it's a very different mindset. Because stock prices change every second, when you make a trade, people want to know what is the price 30 minutes later, 45 minutes later, 48 minutes later, 49 minutes later, and it can become this emotional roller coaster that if things are not going straight up, you can start to feel anxiety, you can start to feel stress, and if you start to see bad headlines, it can entice you to sell before you necessarily want to. Likewise, when you start to see all the news that say people are getting rich, you need to buy before everybody else gets rich, it can entice you to buy. I mean, maybe you shouldn't be. Con number 2 is that a stock is a paper asset. When you buy a share in McDonald's, you are essentially getting a certificate saying you are one of the owners in the company. But you don't actually own any of the franchises, you don't own any of the burgers, you don't own any of the bricks, you just have a contract that says you own a piece of the company. You can compare that to something like real estate, where you own the bricks, you own the windows, you own the doors, you own the land, you own the physical property, versus in stocks, you just have a contract that says you own something, and if that company you invested in, like Amazon or McDonald's or Apple, goes bankrupt, well, chances are you've lost everything. Versus with real estate, you have more control, and if you start to run into financial problems, you can sell off things. I mean, you can sell the property, you can sell the land, you can sell the windows if you needed to. Although if you're selling off the windows in your rental property, you're probably in a pretty rough situation, and that's not going to solve any problems either. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.